Right, good people, are we back? Can we continue? Right, are we there?
Yes, we're back.
Sharp.
I'm back.
So we are looking at direct and indirect costing. Right, so these are methods, these are methods, right, for creating income statements. Right, that is profit and loss P&L accounts. Right, remember we normally do financial statements and we do the statement of P&L for financial accounting. So we have something similar in management accounting. However, there are two methods that can be applied, right, in determining an income statement. We can either use the direct or the indirect method. Right, I want to contrast and compare the two here for you. Right, on one hand, I will have the direct method. On the other, I will have the indirect method. Right, so right, also known as, so these names are interchangeable. Right, the direct method is also known as variable costing method. Right, it has also been called marginal costing. Right, so these terms mean exactly the same thing. This particular method is usually also referred to as absorption costing. So again, absorption costing and the indirect method mean exactly the same thing. Right, how do we differentiate the two? Right, what is the main difference between the two? Who can explain that, good people? Right, the main difference between the two income statements. Who can give an explanation there? Right, the main difference between the two is in the treatment of the fixed. Right, in the treatment of the fixed manufacturing overhead costs. Everything else is treated the same except the fixed manufacturing overhead costs. So the crux of the matter is how are we going to handle the fixed manufacturing overhead costs? Once you understand the differences in treatment, this is the easiest thing ever in the world. And remember, this is an important topic. If you do very well here, you are likely to do very well in other topics. Right, so under this method, we are saying fixed manufacturing overheads. Right, fixed manufacturing overheads, right, are treated as periodic costs. Right, here we are saying the fixed manufacturing overhead costs. Right, the fixed manufacturing overhead costs, right, are treated as a product costs. Right, or slash manufacturing costs. So this here is the crux of the matter. How do we treat the fixed manufacturing cost? In one method, right, we are going to treat it as a periodic cost. Right. In another method, we're going to treat it as a product or manufacturing overhead cost. Right. Let's look at this in detail. I'm going to start by looking at an absorption costing system. This is the default method for financial accounting. So whenever you do your financial accounting modules, you apply the absorption method. The variable costing method is used only for management accounting reports. Right. So what happens here is that, the fixed manufacturing costs are a product cost. Right. Meaning that these are included in determining cost of inventory. So whenever you calculate inventory cost, you include the fixed manufacturing cost. Right, these are included in calculating what we call cost of sales. Right, and by virtue of inclusion in cost of sales, these affect the calculation of gross profit. Right, so in absorption costing, good people, total cost of a product includes the following. Right, remember when you talk about the product cost, it must take into account all the costs incurred in production. And these are the costs incurred in production. Number one, direct material. So we need to calculate the direct material expenditure. We then add the direct labor expense incurred on a particular product. We then add any variable manufacturing costs. Right, any variable manufacturing costs. And we also include the fixed manufacturing costs. So whenever we determine the cost of a product, we have to include all these. Whenever we calculate cost of sales, we have to include all of these because they are manufacturing cost according to the absorption costing method. Right, so that therefore, if I'm preparing my income statement here, right, based on absorption costing, right, obviously I will then have, right, my sales, whatever the amount is, right, then I will less costs of sales. Right, when determining the cost of sales, what is the formula, good people? Where do we normally start? When calculating cost of sales, where do you normally start? Right, usually it's opening inventory. Right, whatever the figure is, and remember, it must include all these things when you're calculating your opening inventory. including the fixed manufacturing cost. Then from there, you now add your manufacturing cost. So which means you add the direct material, the direct labor, the variable manufacturing overhead, and you also add the fixed manufacturing overhead, right? You add what is called an applied cost, right? So get to the nitty-gritty of that. Right, what you then do, you need to add and determine your total. We call this total available for sale. So this is your total available for sale. And then you say less your closing inventory. Then you deduct the closing inventory amount. Right, the answer that you are going to have there, that will be your cost of sales. Right, sales minus cost of sales, you then get your gross profit. So anything included in the cost of sales is a manufacturing cost. Anything not included there is a periodic cost. Then you say less periodic costs. Right, periodic cost, which may be a fixed, right, or variable at mini, right, fixed or variable selling costs. Right, then you calculate the total of these. You deduct these, you are going to get your net profit. Now, this should look familiar because this is the method that we use in financial accounting, except that in financial accounting, we don't normally deal with manufacturing concerns. Usually, we are dealing with opening inventory plus purchases. But the structure is the same. The only difference is that we are dealing with a manufacturing concern. So in terms of absorption costing, this is how we deal with the fixed manufacturing overhead cost. We are saying they are included in our manufacturing cost, which means they are included in cost of sales, which means they determine the amount of gross profit. That is the fixed manufacturing overhead. Now let's look at the alternative, right, which is the marginal costing, right, or the direct method, also known as variable costing. Now, the difference, remember, is the fixed manufacturing overhead cost. So here, when we say manufacturing costs, we make a small adjustment from absorption costing. So we have direct material, we add direct labor, we add variable manufacturing overhead. But more importantly, we exclude the fixed manufacturing overhead costs. So therefore, in our marginal costing method, the fixed manufacturing overhead cost is not treated as a product cost, even though in practice it is because it was incurred in the factory. So we are saying that fixed manufacturing overheads are treated as a periodic cost. What is a periodic cost? A periodic cost is not included in the cost of sales calculation, but is written off after the gross profit. So it is something that you only take into account after you have already calculated gross profit. That's why here you see that our periodic cost were included after the gross profit. So therefore, it means if we are going to provide a structure, right, of an income statement based on the direct costing method, it will look something like this. Right, so this is our income statement. This is going to be based on direct costing method. So we still have the sales calculated exactly in the same way. Then we have less variable costs of sales. So there is our difference number one. Right, the subheading cost of sales. Here we prefix it with variable cost of sales. But when you look at the other method, right, we did not have variable cost of sales. It was less cost of sales directly. So the fact that here I'm actually including, right, the prefix variable, that's your difference number one when creating an income statement based on direct costing as opposed to absorption costing. Right, what it therefore means is that in your cost of sales, you cannot have a fixed cost because you're specifically indicated that you want only the variable cost of sale. Next, when you say opening inventory, and you calculate the value, we will show in the example how to calculate opening. Right, your cost of inventory should never include the fixed cost. Right, you must exclude the fixed costs. So therefore, the value of your inventory will only take into account the direct material, the direct labor, and the variable manufacturing cost. So there will be a difference in the figure that you calculate. Based on variable costing, your opening inventory value will be smaller than the absorption method because in the absorption method, you included a fixed cost there. Right, then you say add. It will be direct material, direct labor, and variable manufacturing overhead. So you don't include the fixed manufacturing overhead cost here. Right, then you will have your total. So we have a total available for sale. Then we say less the closing inventory. Again, your closing inventory will never carry fixed costs. Right, we have a slight difference again. Right, remember this method, as soon as you say less closing inventory, you go straight to the cost of sales. But based on this method, you continue downwards. And you now add other variable costs. So these can be non-manufacturing. You determine all the other variable costs, you add them. Right, only then can you then go now to the cost of sales. Right, deducts sales minus all your variable cost of sales. The answer that you get is what we call contribution. Right, or marginal income. Right, so these terms are used interchangeably. So there is another difference. We don't have that in financial accounting. We only know the term gross profit. So in absorption costing, we have gross profit. In direct and indirect costing, we have contribution. And then from there, you can say less. Remember, all the variable costs have been included above, so you can say fixed costs. It is correct also to say periodic costs. So now in your periodic costs, the fixed cost now join the periodic costs. So you will now have fixed manufacturing overhead. Now that's different from the previous one because the fixed manufacturing overheads in the previous, right, had been included together with the direct material, direct labor in determining the cost of sale. But when we go to this method, we did not include the fixed cost until after we had our contribution. Right, then we can have selling costs. Right, then we can have admin cost. All of this must be fixed costs because all the variable costs will have been taken into account there if they are non-manufacturing. Right, so that when you now deduct this cost here, you are going to get net profit. And that would be the final calculation. Right, so with practice, this is usually a very straightforward calculation. It's just an income statement easier than the ones that you do in financial accounting. So it should be easier. But you must know the small little nitty-gritties, right? And also get used to calculations where you have got a question that stretches over 3 pages and you've got to look for information up and down those 3 pages. But otherwise, at its basic, this is what we are talking about when we talk about direct and indirect. Right? Any questions, good people, on what we have? Right? The other small little differences, right? In absorption costing, we have gross profit. Here we have contribution. We don't have gross profit. Right? And also it is sometimes worth noting that the absorption costing method is the default for financial accounting. Right, and hence we use International Accounting Standard, we use GAAP, we use IFRS. Right, these are standards that are associated with financial accounting. Right, so that when you have a statement and the question simple tells you that the statement uses International Accounting Standard, even without looking at any other information, you will know that the entity applies the absorption costing method. Right, then the other method, which is the direct costing method, right, this one is used for management reports. Right, no standards are used. Absorption costing is intended for both internally and external users. That is the indirect method. So therefore, the documents must be standardized so that the next person can be able to read them, applying the standards. Management reports are designed specifically for the management of a particular entity. So there is no need for standardization, but the reports must be tailor-made to suit the needs of management. So that is another small little difference there. So we then have the direct method, we then have the indirect method. Any questions before we attempt one or before we attempt a question? Are we clear on all these, good people? Right, are we there? Right, are we still there? Right, you are very,
Yes, sir.
yes, it's very quiet. I know you ask questions when it's difficult. So for now, so I'll assume so far so good. Right, I'll look at a question. It's an introductory question on the direct and indirect method so that we set the tempo for this particular topic. So we want something light that we can easily do and understand. And then after that, we'll take on a much bigger challenge. Right, so I've got a question here. Right, and then the question has got a number of requirements. Let's read the question. It says the following information was obtained from the accounting records of XYZ Limited, right, for the year ended 31 December 20X0 and from the budget for 20x1. So we have just finished the financial year ended 20x0, right? And we have also compiled at that particular end of the year the budget for the next year, which is 20x1. Right, so we are given information on units. We have the inventory at the beginning of the year. We have production for the year. We have got sales for the year. And then we are given the rand values, right? The first set of rand values were given for fixed costs. We have got manufacturing costs. We have got sales and admin. Then variable cost, we have got manufacturing, and then we've got sales. So here they have already combined the direct material, the direct labor, and the variable manufacturing cost. So when they give you a figure and say manufacturing variable cost, it already combines the direct material, the direct labor, and the variable manufacturing overhead cost. Right, and then we have got the sales price per unit, which is given. Then the enterprise uses the weighted average method of inventory valuation. Refer to topic 3 if you need to revise the method. Okay, we'll go to that. Right. Okay. Right. Are you guys getting me? Are you hearing me from your end? Right. Anyone with a challenge besides the person who asked? Right. But are you able to hear me now? Is it better? I think it was just the network having a small challenge, but I think normally it comes back. Okay. All right. So I think it's better now. Thank you. Right. So this is the info, and then let's go to the requirement. Right. Draft the budgeted statement of comprehensive income for the year ending 31 December X1, 20X1, according to the direct method and then according to the absorption method. Right. And then in order to illustrate the differences between the two approaches. Right. So what we need to be clear on, whenever you have an income statement request from a question, you must check on whether you are creating a budgeted statement or the actual statement. And now remember, this here is the actual information that we have compiled based on the 20x0 year. This is the budgeted information. We can create an actual statement. We can create a budgeted statement. So it is important that you, before you answer the question, you check exactly which statement you are combining so that you don't do the opposite. Right, so here on number A, we're going to be creating a budgeted statement. Right, so this is our budgeted income statement. Right, for the 20x1 financial year. Right, this is based on the direct method. Right, so we're going to base this calculation on the direct method. Right, so obviously being an income statement, our starting point will always be the sales. This is where we'll start. Right, on the sales, it's always very simple. Right, you need to determine the number of units that have been sold. So when we go to the budget, because we are creating a budget statement here, we go to the sales for the year. We see that we sold 140,000 units. So therefore, we'll have 140,000 units. Right, this we need to multiply by the number of units or by the selling price. So the selling price per unit was 35. So we multiply by the 35. So it's your quantity sold multiplied by the number of units that were sold. So 140,000 by 35, then we are going to have 4.9. Right. Then we say, let's remember this is direct costing, variable, right, costs of sales. Right. Then we are going to start with the opening inventory. Now let's be reminded that opening inventory is already there on hand at the beginning of the next year. What we call opening inventory is closing inventory in the prior period. While we are making projections, which in this case is a budget for the next year, let us remember that opening inventory, we don't have to make projections because it's already there on hand at the end of the year. So only for the opening inventory, we have to visit the previous year or the actual information, right? Only on the opening inventory. Everything else we use projected figures. So we go to our previous year. Anyway, inventory at the beginning of the year, it is given 7,000, which comes from the fact that we did not have any opening inventory in the prior year, but we produced 168 and only sold 161. What is remaining is 7,000 units. So therefore, we need to come here and say 7,000 units multiplied by the cost per unit. So we need to go back again to the prior year and say, what is the cost of this 7,000? Remember, this 7,000 comes from there. It is the residual that was left here. So therefore, that particular cost must be determined from the previous year. When we go to the previous year, we are then given fixed costs and variable, both manufacturing fixed cost and variable manufacturing costs. Right, the fixed cost, as you can see, we are given in total. The variable cost, as you can see, they are given per what? Per unit. Now we need to make a decision based on the variable costing system. What are we supposed to include in costing our product? Now that is a question for the group. Right, when determining the cost of inventory for an absorption costing system, which cost do we take into account? Which cost do we not take into account? Right, good people, that's for you. Right, the first thing that we've got to clear, whenever you determine the cost of a product, you must use manufacturing costs in either system, either absorption or variable costing. So you cannot use anything that is not manufacturing, which means automatically the sales is out and the administration is out. Right, then we have to go further and say, if we are going to be using manufacturing costs, remember manufacturing cost, there is the fixed element, there is the variable element. In which method do I include both variable manufacturing cost and fixed manufacturing cost? Right, very clear, we are not going to be using the fixed cost. The fixed cost must not be included, right, in absorption costing. So here we are doing in absorption costing, we include both. Thank you. You were answering that. In absorption costing, we include both the fixed and the variable manufacturing costs. But in the direct method or the marginal costing system, right, we only use variable manufacturing costs. Right, so therefore we have to find out for each unit of production in the prior year, what was the variable manufacturing cost per unit? It was 8.4. So that is what we use here. Remember, this 8.4, it already includes all the variable manufacturing costs, which means it includes direct material, direct labor, and variable manufacturing overhead. So that will give us a value of 58,800 today. Right. Any questions concerning that from the floor, good people? Are we on the same page so far? Right. Are we clear? Right. Next, let's add our variable manufacturing overheads. If these were not given combined, we're going to say, let's add the direct material, the direct labor, and the variable manufacturing costs. This time now, we are using the budgeted figures costs. We were only using the previous year's actual cost for the opening inventory because it was manufactured here, and therefore its costing comes from the actual. Now I then say per each unit produced in the current year, the variable element is 11.2. So we say 11.2. Then we say how many units were produced in the current year. So we go back to the question and say our production for the year was 154,000. So here we multiply by 154. So very clear. For sales, you must multiply by the number of units that were sold, which is 140. For production, you must, however, multiply by the number of units that were produced, right, which is that particular amount, which is 154. So 154,000 units were produced, each at a cost of 11.2, which gives us a total of 174 or 1,724,800. So we add the two. Right, we don't add the fixed manufacturing overhead. So now that we've got the total of our variable of manufacturing costs, we now add to the opening inventory. And that is going to give us a value of 178,600. So this is our total available for sale. Right, any questions on the calculations so far, good people? Are we clear? Right, hopefully we are. Let's go to the closing inventory. Now, when it comes to the closing inventory, you have to consider the method of valuation of inventory, where they say that a inventory valuation method, we are using the weighted average cost method. Right, so when you use the weighted average cost method of inventory valuation, what does this method mean, good people? When someone says to you, we are applying the weighted average cost method of inventory valuation, what does it tell you? Right, when inventory gets into the warehouse, it gets mixed up. We cannot tell what was opening inventory and what we produced currently. Everything is mixed up in the warehouse. So that when we now remove the inventory from the warehouse for sale, we cannot tell whether we are taking from what was there in opening inventory or what was produced in the current year. Because we started in our warehouse with 7,000 units, and then we added 154,000 units. The products look the same, they are mixed up. So therefore, it simply means there is a possibility that in your closing inventory at the end of the year, some of the units that were in opening inventory are still there if you assume the weighted average cost method. And what it means for your calculations when determining closing inventory, you cannot ignore the opening inventory. Your calculation must include the opening inventory because some of the units that you have in closing inventory could have come from opening inventory. Are we clear about that? The first thing that I want the closing inventory units. How many units do I have in closing inventory? So before you calculate the value of closing inventory, you start here. So you say opening inventory. How many units did you open with? 7,000 units. So that would have been our opening inventory. And then what was your production for the year? Right, then you say production units, 154,000. If you add these two together, you get 161. Right, then this is the total available for sale. Right, this is the total available for sale. And then you say less your sales. How many units did you sell from this? We sold 140,000. So therefore, it simply means that in our closing inventory, we are now left with 21,000 units. So those are the units in. Right, so once you have that, you then have your closing inventory. Right, so you have your closing inventory units. Right, what you now need from here is to calculate the value per unit. Right, you need the value of closing inventory per unit. Right, when you calculate the value of closing inventory per unit, this is what you do. You say total costs divided by the number of units that give you that total cost. So in this way, you'll be able to get cost per unit. So what to do, remember we are using the weighted average method. So let me just add that here. Right, when you use the weighted average cost method, you are saying that in your 21,000 closing inventory, some of the units, which is part of this 7,000, which was in opening inventory, may still be there. So now you take the total cost that includes both opening and current production, which means you take the 1783,600 here. So that's your total cost. Right, including what? The opening inventory. Then you divide by the units that gives you that total cost. Let's look at that total cost. Now, that total cost here comes from 7,000 units in opening inventory plus 154 units produced in the current year. So you need to add those two and then divide them into that cost. So you say 7,000 here, which is an opening inventory plus 154,000. So these are the total units that give you that total cost. So what is the combined cost per unit? All right, so that gives you 11.08 Rand per unit. Now, if I want to calculate now value of closing inventory, right, in total, right, it will have to be the number of closing units multiplied by a cost per unit. Closing units calculated 21,000, cost per unit 11.08, and then we get the value of closing inventory. Right, so all in all, we're going to get 232,643. So this is the value that we're going to have here. So we're going to have 232, right, 643, which is our closing inventory value. Right, any questions on the calculation of closing inventory based on the weighted average cost method? Right, are we sure we are clear on this one, good people? Right, are we on the same page? Let's make the class interesting, good people. Let's interact. Right, how were you going to calculate this if you were applying the FIFO method? Right. When you apply the FIFO method, good people, remember this is first in, first out. Right. We sold a total of 140,000 units. Our opening inventory was 7,000 units. So what it means, of that 140,000 units in sales, the first 7,000 was sold from here. And then the remainder now, right, which is 133,000, was then taken from current production. Are we clear on that? Right, good people, are you understanding that? That's,
Yes.
yes, that's first in, first out. So what it means, therefore, is that in our closing inventory, we no longer have any opening inventory units that have been sold off. So closing inventory is actually made up only of current production units. So if we are now calculating closing inventory and we use the FIFO method, we must not include the opening inventory. We ignore the opening inventory. So our calculation would have been like this. We would have said, how many units did we produce in the current year? We say units produced in the current year, right? We then have 154. So we'll then go to a calculation. We'll say, what is the current production cost? Right, the current manufacturing cost, which is your variable manufacturing cost, is 172,800. So we're going to say 172,800, which is only for current production, divided by the current units produced. We will have the cost per unit, and then we'll multiply that by 21,000 units. So this is how we would have calculated if we were using the FIFO method. We would have ignored opening inventory in this calculation. But based on the method that is required in the question, right, we then said we are not going to ignore opening inventory in our calculation. The reason being, the opening inventory units, we are assuming that some of them could still be there at the end of the period in our closing inventory. So therefore, this time we now took our total available for sale, which includes both opening and current production. But we are cognizant of the fact that that total cost includes the 7,000 in opening inventory and the 154. So that is how we do the calculation. Then from there, we then say add other variable cost. We go and check which other variable cost do we have. We have the selling cost. So therefore, we are going to include the selling cost here. Right, selling cost, we have the selling cost per unit, which we are given as 2.8. We use current production cost. Now, selling costs are determined by the number of units sold, not the number of units produced. So it will be 140,000 by 2.8, which is going to give us 392,000. Right, once we have that, then we are able to determine our cost of sales. So we add the 1,550,957 plus 392,000. Then we are going to have a figure of 1,942,957. From the 4.9 million, then we are going to have a figure of 2,957,043. And what do we call that? Contribution per unit. There is no gross profit. Sorry, contribution in total. There is no gross profit in marginal costing. Then from there, we say less fixed costs. Right, on the fixed costs for the current year, We have got manufacturing 336 and sales and administration 252. So we'll say manufacturing, and then we have sales and admin. So this one is 232,000. This one is 336 and 252. So that would be 336,000. Right, then we'll be done with our income statement. So we just add here. Right, then we get a figure of 588,300. Right, from 2957043, then we are going to have a net profit of 2369, right, 043. Right, so at its most basic, a variable costing statement would be something like this. So of course, remember, this is an introductory question. Right, to set the tempo, we have to look for a much more difficult question, much more complicated example than this. But as long as you understand this, you won't have a problem with a complicated example. So this will represent our net profit. Any questions, any additions from the floor with regard to the direct costing method? Are we clear? Right, are we there?
Yes, we're clear.
Wonderful. Let's look at the absorption costing method. Right. Okay, thank you. So we want to look at the absorption. Right, costing method. Right, we are still using the weighted average cost method. Right, most of the things and the calculations are similar. Our biggest difference is simple on how we are going to treat the fixed manufacturing costs. Right, so we start with the sales. Right, the sales will not change. We sold 140,000 units at 35. So we still have the same amount that we got 4.9. Right. If you see yourself having a different sales amount between the two methods, something is wrong. Then we say cost of sales. Right, so as you can see on my cost of sales, I don't have to specify on this one whether it is variable or not. Here we have to say variable cost of sales, which means up to contribution, we cannot include a fixed cost. But I've not done that here, which means I can include the fixed cost. Let's start with the opening inventory. Right, the opening inventory is still 7,000 units, but the cost per unit will be different. The cost per unit in terms of absorption costing will be more, right, because I am including the fixed costs. So I will say calculation number one, right, opening inventory costs per unit. Right, so opening inventory, we are looking at the cost per unit. This should include the fixed manufacturing costs or overhead. This should include the variable manufacturing overhead. Now, the variable manufacturing overhead is given in the question. Right, remember, don't forget that opening inventory was manufactured in the prior year. This is where the 7,000 is coming from. So its costing is in the prior year. This is the only time that you visit the prior year to determine the value of opening inventory. So when we go to the variable element, The manufacturing cost there is 8.4. I don't include any non-manufacturing cost in valuing inventory. So you take manufacturing cost and we take 8.4. We ignore the selling and the admin. But because I'm using absorption, I must also add a portion of the what? Fixed manufacturing overhead. Right, so therefore we say 254. This here is a total. To get the cost per unit, I must divide that by the number of units that gave me that cost. This is a manufacturing cost. It is determined by the number of units produced in that particular year. So if we have a cost of 252 after producing 168 units, what is the cost per unit? Divide the total cost by the number of units produced. So 252,000 divided by 168, that is going to give me how much? So that gives me 1.5, which means ultimately I have 9.9 here. So this is my cost per unit of opening inventory based on the absorption costing method. Then I multiply by 9.9. So that's 9.9 multiplied by 7,000. That now gives me 6,900. So you can see my opening inventory here is more than the opening inventory here. Right, because here we only used variable manufacturing cost. We did not include any fixed costs based on the variable costing. But on absorption costing, opening inventory is part and parcel of the calculation of the value of inventory. Then next I say add variable manufacturing overhead. How many units currently produced? 154. What was the cost? 11.2, which is given there. So now we are reverting to current production cost and the number of units produced. So 154,000 plus 11.2, and that is going to give me 154. 154,000 by 11.2, that gives me it gives me 1,724,800. Right, but this time I'm going to add also the fixed manufacturing overhead cost. Now, this is a simplified version. When we get to more complicated versions, we are going to be asked to calculate the actual statement. When you have the actual statement, there is an adjustment that you make here. You use applied. Right, so please note the applied fixed manufacturing overhead is only used on the actual statement. If it's a budgeted statement, you use the budgeted what? Fixed manufacturing overhead cost. The next question that we are going to do, which will be, we'll start with it next week, we will deal with a more complicated question with an actual statement so that we show the differences between the budgeted and the actual. But here we're using a budgeted statement, so we go and check the budgeted fixed manufacturing overhead cost, which is 336 here. Right from there, we then close, we add these three, we get our total available for sale. Right, so we'll say 69,300 plus 1,724,800 plus 336,000. Then we are going to have 21,30,000. Then we say less closing inventory. Right, remember we are still using the weighted average cost method. So we take the total cost inclusive of opening inventory and current production cost. So 21,30,000. We divide by the number of units that give you that. So which is in total 161. Right, then we multiply by the 21,000 that we already calculated in the previous. So the 231 is the total cost. The 161 is the total number of units that give you that cost, which is opening and current production. So if we say 2,130,000, right, divided by 161,000, multiplied by 21,000, we are going to get 277. Right, 826. Right, once we have that, then we add everything together. So it's 2,130,000 minus 277,826, and that is going to give us 1,852,174. Right, and when we deduct that from the sales figure, we then get a figure of 3047, right, 826, and that is gross profit. Right, any questions so far, people? Are we following? Right, less the periodic costs. Right, on the periodic costs, we then have variable selling costs. Remember, 140,000 units were sold at a price of 2.8 each. Right, same with what we calculated before. We sold 140 units, which is the sales, and the selling price per unit, and the selling cost per unit were 208. Right, so therefore we say 140,000 by 2.8, we are going to have 392,000. Right, next we then say, what else do we have in terms of the cost here? We have the fixed sales and admin. Right, this is the 252 that is given there. We don't have to calculate. Right, then we simply add those two. Right, 392,000 plus 252,000, we are going to get 644. Right, deduct that from gross profit. Then you are going to have a value of 2403, right, 826, and that is our net profit. So obviously, these two methods don't give you the same net profit. The net profit will differ. And the main difference that we have for the differences here is how we have treated what we call the fixed manufacturing overheads. Everything else is being treated the same, except the fixed manufacturing overhead. That's where the crux of the matter is. Right. Any questions, good people, on these two? Are we on the same page? Right. There is one more question that is there. Right. Right. All right. So we have done that. We have done that. Show the calculations to the nearest rand. You may assume that the 201 budget opening inventory was correctly valued. That values the actual. All right. And then, all right. It's not there. There were only those two requirements, but I want to add something. Right. Usually you get a request to reconcile the net profits. Now, reconciling means you want to agree the figures and understand where the differences are coming from. So if we start here with absorption, net profit, which we got as 2403,826. So we want to reconcile these two net profits. We want to make them agree. And we are saying the difference between them is how we have treated the fixed manufacturing overhead. Now, the fixed manufacturing overhead has affected both our calculation of opening and closing inventory. So therefore, if we want to reconcile, we must reconcile the differences in opening and closing inventory. So here we say, right, differences, right, in opening inventory. So what we have done, which is to treat differently the fixed manufacturing overhead cost, would have affected the opening inventories in this way. When you go to absorption costing, our opening inventory value is 69,300. This is more than the opening inventory that we have for variable costing, for the mere fact that in absorption costing, we included the fixed manufacturing element, which we did not include here. So now we then have a figure of 58,800. So that's our opening inventory value. Right, so that therefore, when we say 69,300 minus 58,800, then we are going to have, right, 10,500. Now you have to understand the impact on profitability of opening inventory. Opening inventory by nature, it increases cost of sales. When you increase cost of sales, then you reduce net profit. So the fact that in absorption costing, we have got a bigger amount of opening inventory, it means that our net profit was deducted by an extra 10,500, which is not there in variable costing. So if I'm going to calculate from my absorption costing and achieve variable costing, I must add back this difference. Right, good people, are we clear on this? Right, are we there? Right, are you understanding it? Right, wonderful. So I'll just repeat it again so long. Remember, absorption costing, which is the net profit that I've started with here, right, includes fixed manufacturing overheads in the calculation of opening inventory. That's why it is bigger than that of direct costing. It simply means that in calculating absorption costing, I increased my cost of sales by 10,500 compared with what? Variable costing. An increase in cost of sales, which comes from an increase in opening inventory, it reduces profit. So if I want to work from absorption costing to variable costing, I must add back this amount. But we don't end there. We also look at the differences, right, in closing inventory. Again, the closing inventory based on absorption costing will be bigger because it contains fixed manufacturing overhead costs. So when we check here, our closing inventory value based on the absorption costing, 277,826. Right, based on the other method, which is the variable costing, it's much lower. And the figure, as you can see, 132,643. It's 232,643. Let's confirm that. Right, that's 232,643, correct? And then we say 277,826 minus 232,643, right, which then give you an amount of 183, which we are going to deduct. Now, closing inventory by nature, has the impact of reducing cost of sales. When you reduce cost of sales, you increase profit. So since we have a bigger closing inventory here, it means our profit for absorption costing is higher by 45,185 compared with what? With the direct costing method in as far as closing inventory is concerned. If I want to agree these figures, then I've got to less this amount. If I'm doing everything correctly, I will get now to the net profit, right, based on direct costing. Right, so therefore we say 2403 right, so 2403 826 plus 10,500 minus 45,183. Right, if we are calculating correctly, we should get the same profit. So here I'm going to get an amount of 2369,143. So that figure must tie back to the profit that I have there. Right, so it ties back to that figure there. So if everything balances like this, then everything is 100% correct. Right, so that therefore sometimes in questions, they may give you absorption profit. And then they don't ask for the income statement for direct costing. They simply say, what is the net profit for direct costing after having given you absorption costing? You don't have to create an income statement. You just calculate it in this way and you get the correct figure. Right, that's direct and indirect costing. Remember, this one is breadbasket of the module. It's one of those topics that is pervasive throughout the syllabus. If you don't get it, you will make mistakes even in other topics. You will deal with a lot of topics that simple require you to calculate contribution. You will deal with a lot of questions that may simply require you to calculate closing inventory or opening inventory. So even if you're not being asked this statement, but the principles are pervasive right throughout the syllabus, you need to be clear on this particular topic. Right, I see there's a chart on the group. Let's check that and see. All right, thank you. So what then is needed? This one, remember, is a simple question so that we lay the foundation. Right, what is needed is to then get a more complicated examples and then we practice those. But you will see, as long as you understand what we have covered here, those examples are simply a repetition of that. What will probably be there is that the information now, you will have to look for it more intensively. What am I saying? When you go to this question, everything is here. You have been given the information. But the questions that you normally get at this level, remember, it will be a lot of topics combined. Even in test number one, you will find that in test number one, you have direct and indirect costing. You have maybe, say, cost profit volume analysis. You have another topic, maybe 3 or 4 topics combined. So the question paper will be one covering all those topics. What you need to answer this question, some of it you will find on the first page, some of it on the second page, some of it on the last page. So that now takes practice to be able to pick out the information and finish on time. But in terms of the structure, the calculation, the principles, you get them from here, and then you apply them on a more complicated example. So for this one, I will hold it here for this week. When we meet next week, right, we are going to start with a revision, or maybe let me say a practice question, a complicated one, right, for direct and indirect question. So I'm going to use a past assessment to go through this one. So that's direct and indirect costing. Then from there, I will need to check the syllabus again. I think we do have cost profit volume analysis, if I'm not wrong. So if I'm correct, then we continue to the cost profit volume analysis. So a good student goes and looks for a question on the question bank. You practice also one on direct and indirect costing. Right, you go and go to your textbook, uh, or if you are already clued up on the topic, go to the study guide, look up cost profit volume analysis so that you prepare for the class ahead. And then when we meet, you will have questions for me to ask. You would have already covered the topic. You know your weaknesses, you know areas that need clarity, and you'll be able to ask the correct questions. Right, so let's end here. I'm going to download the session, and then I'm going to see how I will share it with you. What we'll do, remember, I think this module is quite tricky for most learners. But through experience, I know that if we do more classes for the module, we find time to meet more often, then we will do very well on the module. So for the trial sessions, yes, I'm doing one session per week for this one. But for the classes, when I start the classes after the third one, I'm going to add two classes of this module, one weekend class, and then during the week, that's where we practice. For example, if we've done direct and indirect costing, right, whatever we have done during the week, maybe on Wednesday, we then bring the question and we cover it during the week after hours. Right, so that on Saturday we start a new topic, and then during the week we'll reserve it for practice questions. So if we do that and we practice enough, and the students do their part on their side, which is to practice also on their own, there is nothing difficult about management accounting. If you ask me, management accounting is much more easier than financial accounting and auditing than tax. Financial accounting, yes, sometimes it's understandable. There are nice topics there, but the material is too much. There's too much work to cover. In management accounting, the work is not so much. What you just need is to constantly practice your questions and you will get it right. Without practice, you can't get management accounting right. And it's nothing to do with, being good with your schoolwork or whatever. Financial accounting, most of the time, you start with it in the first year. Right up to this level, you'll be doing the same thing. So if someone says create an income statement of P&L, because of practice over time, you already have the structures, you already have the formulas, if they're formulas, right? You are just increasing the level. The problem with management accounting, at times, you really learn it in that level. That's when you bring in a lot of different elements, right? Sometimes you have some of these topics in the second year, but they are watered down. So what it means, you get to this level without as much practice as in the other topics. But if you put in the work, you will see it's much more easier than financial accounting by far. So you can pass this module, but it's not for lazy people. It's for hard workers. It's what defines financial accounting. If you can pass management accounting, then you can do anything with your financial accounting. You can do your CTA, you can pass your board exams. All is good. Right, let me end here. I will see you when I see you tomorrow if you are attending the FAC module. We are going to be doing tax-day income taxation. Thank you very much. Unless if there is a question or a contribution from the floor, we are done for the day.
Sir, sorry, I would like to ask the example that we just did, where is it from?
I will share it with from another material that I got from another school that is teaching CTA.
So you can please.
Yeah, I will share the questions with you when I share the lesson.
Thank you.
You're welcome. Thank you. Right. Thank you, good people. I think there's something on the chat. All right. Thank you very much. See you when I see you. Thank you.